guys, hope you are enjoying this learning series. Now we are going to enter into section 92, which is the first session. That is the charging provisions under the transfer pricing entire chapter. Now, why section 92 is most important section under that entire provisions? Obviously, it's a charging section, but above all that, if you don't fundamentally understand section 92, you may not go ahead with 92A or 92B easily. All right, so I'll be sharing the screen round wherein we'll be discussing section 92, which is the charging provisions under this transfer pricing provisions. So guys, as you can see, I have opened here that section from the Bear Act. That is, I have just opened that section here, section 92. The first statement of, or the first subsection of section 92 clearly says that any income arising from an international transaction shall be computed having regards to the arm's length price. Now what it means? It means that there should be some income, there should be some international transaction, and if these two conditions are satisfied, you are required to compute that, required to undertake the arm's length price analysis to determine whether that income from international transaction is at arm's length price or not. Right, let me just go to the mind map as well. Now, I am also discussing the other provisions, but section 92 mainly focuses on this particular conditions. So I'll read it again. The provisions of transfer pricing shall be applicable on fulfillment of the following conditions, right? There should be an international transaction between two or more associated enterprises. At least one of the associated enterprise should be non-resident. This will discuss, and because these are from 92 and 92B when they were correlating, so they have just mentioned here. The international transaction should give rise to any one or more of the following, which is either income or expenditure or interest payments. Now, if there is an income, or even if there is an expense, or even if there is an interest payment, then section 92 gets applied. Now, I have also put one note that in certain cases such as availing or providing of loans, guarantees, purchase of fixed assets, account receivable, payable, etc., still the TP provisions will be applicable, though they may not affect profit and loss directly. So you can understand, there could be a question that whether a dividend payment to the shareholder can be considered under income tax, transfer pricing provisions or not. The answer to that would be no, because it doesn't affect my profit and loss. If you see clearly, section 92 says that any income from international transaction is required to be at arm's length price. So this other transactions which have been put in under this note may relate directly or indirectly to your profit and loss account, may affect your profit and loss account, such as bad debts. If there's a loan, then there's an interest payment also. If there's a purchase of fixed asset, then there is a depreciation. So this all things affects your profit and loss, but dividend doesn't affect your profit and loss, and that is where generally we don't include dividend, or we don't benchmark dividend income or dividend payments. All right. So then after section 92 subsection 2 says that the provisions shall also apply where the A is mutually agreed to share some cost or expenses or contribute to cost or expenses in connection with a benefit, service or facility to any one or more A's. So if there is a sharing of some expenditure between two related parties, that is also covered under section 92. Or in case both the parties are contributing to something and they are creating something, or they are providing services by making contributions from their own ends, that is also, so the dealing between these two parties or that contribution and sharing of costs and expenses are also covered under transfer pricing provisions. We'll just go ahead and learn more aspects on 92. I hope 92, the provision wise, it is clear to you. But we need to also understand certain key aspects which are emanating from 92 and which have been emanated on basis of certain rulings as well. Let me just open also that. there should be any income. So as we read that there should be any income which should arise from an international transaction. So now what are that aspects that we are required to consider? First is, what is income? Incomes are basically covered under section, so definition of income is provided under section 2, and further under section 9 also there are certain events or certain activities which have been called as incomes. Apart from that also there may be some incomes in some other provisions under the act. So first you need to understand that what is income, right? So these are the incomes which are covered under the act. Then after, if there could be a situation if there is an income but however it is exempt under the act, then there is a clear position that no transfer pricing provisions will apply on that particular income. Alright, now what if that income is chargeable to tax under the act but it is exempt from DTAA? Then also no TP provisions shall apply. Let me just clarify that in certain capital gains transaction where there is a sale of shares or probably any of the capital asset, there could arise a tax liability in the other country in which the particular asset is located, and that is where courts have held that on certain transactions you cannot apply transfer pricing provisions because that particular income was not chargeable to tax under that particular jurisdiction itself on virtue of DTAA. I have also mentioned here two rulings. If you can just go through that, it's Vandenberg Group BV 289 ITR 464, that's an advanced authority ruling, and again a Praxair Pacific Limited, that is 326 ITR 276 AAR. These are the two main rulings on which you can say that if the income is exempt under the DTAA, then also the TP provision shall not apply. Now, I also want to tell you one thing, that don't mix the above concept with routine business transactions such as purchase, sales, etc. So in many DTAAs, the FTS, that is technical services or fees for professional services won't be chargeable or royalty won't be chargeable. But when you are making payment, though it is not chargeable in the DTAA, but that doesn't mean that that income is exempt and no transfer pricing provision should apply on that particular part. No, it is not like that. So don't mix the above concept with the routine business transactions such as purchase, sale. I would always recommend that in case if you come across such transaction, take a conservative view. So report in Form 3CB and possible, and if you are able to benchmark that transaction, do also benchmarking of the transaction rather than advising to the client and getting into the more aggressive position. I would request you to be on a conservative end. So guys, these are all aspects of section 92. Now I also discussed one practical case which has happened. I am not sure if the other consultants would have same position or not, but let me just tell you also one question or one situation which I faced. Now there was this entity in India which imported some semi-finished goods, right, at X value, right. Now during the year, as due to corona they didn't have any operations during the year, or they probably didn't use that particular goods which they imported, and that is where under the closing stock they shown the X amount only as a part of their closing stock because they didn't utilize only that goods. Now the case was before me, and I was thinking about how to benchmark this transaction because during that year there was no movement in that goods, and the valuation of closing stock which was done by the stat auditors was at the cost. So technically in the profit loss there was purchase of X amount, and under closing stock there was this closing stock of X amount. So if you net off down, that's a zero part, right? In one of the case when I was dealing in Bangalore, I saw one argument from the council that if you are decreasing the purchase price, then you should also decrease the value of closing stock in the profit and loss account. So I took a reference, or I took I recollected that entire part, and somewhere in this transfer pricing, so how do I benchmark that? Because there was technically no income. If the officer takes a position that whether the income, if the purchase amount needs to be reduced, then the officer also has to give a compensating adjustment to the closing stock to arrive at the final income which is chargeable to tax on the assessee. So that is where I took this this type of weird position that section 92 is not applicable on that transaction, and still we did benchmarking, but still we wrote in the report that it is not applicable prima facie, Because if the transfer pricing provisions are itself not applicable and we are of that view, then what method we will apply? So that was a practical case before me. I have not written down that part because even that is a debatable thing. But yes, fundamentally I could not go ahead to apply section 92. My view is that section 92 should not be applied in such scenarios. Yes, but it may be applied that when you are purchasing some goods and out of that particular amount of goods you have used that goods to sell or make value additions, then obviously your 92 will be applied in such scenario. It's not that this was a particular special situation where I was thinking much but I couldn't arrive at a transfer price. So that is where we need to be fundamentally clear on this aspect on application of section 92. I hope this clarifies. I'll meet you in next video wherein we are discussing the other provisions. Thank you.